Hey guys, hopefully this is started and live. Just gonna take a sec. If people are seeing this, leave something in the comments so that we know you're actually seeing us and we are live. Okay, looks like we're starting. Perfect. So awesome. Thanks guys. Thanks for tuning in. Welcome to the security tokens and ICOs. We're looking at the future of everything cryptocurrency roundtable. We've got the best and brightest Polymath, StartEngine, and Corl here. I wanted to let everyone introduce themselves in a sec, but first, who am I? My name is Matt Ward. I'm Chief Growth Officer at Corl, so you can take anything that I say as somewhat being endorsed by Corl. But everything that people say here is, of course, subject to, shoot, I didn't mean to say that, and all of that good stuff. We wanted to get the smartest, brightest people when it came to security tokens, token offerings, and the future of ICOs on a roundtable together. I think we've got that. We've got Graeme, Howard Marks. Graeme, I forgot your last name. Wow, that's terrible.
Moore.
Graeme Moore with Polymath. You can see the shirt. Howard Marks, StartEngine, founder of also Activision, and then Sam Kawtharani, founder of Corl. Everybody, just take a sec to introduce yourself. Go first, Graeme.
Yeah, so I'm Graeme Moore. I'm the VP of Marketing at Polymath. I've been with Polymath since September of last year and doing all things marketing related.
Howard?
Hey, I'm Howard Marks. I'm the CEO of StartEngine, and my mission is to help entrepreneurs achieve their dreams. And we've been doing crowdfunding since 3 years ago when the Jobs Act came out, and did about 150 offerings, and we're going to do about 500 this year.
Right. I'm Kawtharani, co-founder and CEO of Corl, and we're basically bringing a new investment opportunity for businesses through a revenue sharing investment that aligns businesses and investors to kind of grow the community and grow the ecosystem together.
Basically, we saw 99% of businesses were not fundable by VCs, so we're trying to help them grow their businesses. Thanks for tuning in, everybody. Before we get started, quick question, just for transparency. What cryptocurrencies, assets, et cetera, are you guys invested in so that no one gets the wrong picture?
I'll go first, I guess. Actually, I'm looking at my Bitcoin stocks right now. I have Bitcoin, Ether. What else? I have Poly tokens. Poly token is the native currency of the Polymath network. What else do I have? 0x, Video Coin coming soon, and Civic. A bit of Bitcoin Cash, but not too much. It's mainly as a hedge against anything going completely awry in the world. Yeah, that's pretty much all I have.
I'll go next. So I have basically the main ones. So Bitcoin, Ethereum, Litecoin. I have a bit of Ripple, Civic, Bloom, big fan of the project, and 0x, and of course, Poly.
Yeah, I have Bitcoin, ETH, Bitcoin Cash. I got a little bit of Civic, and I forget, there's a few other coins I have, but there's not significant holdings at all.
And the same for me, Bitcoin, Ethereum, Litecoin, and Monero. The one, if they crack down, that I feel good about. So let's jump into it now. So security tokens, initial token offerings, we were talking about this before. How did you guys get into this space? Let's start with you, Howard. What was your backstory?
So my backstory is, as you mentioned, I've been an entrepreneur for 35 years, started Activision. Actually, I'm writing an article that shows how the video game and cryptocurrencies have a real good meeting point. Vitalik, for example, was playing World of Warcraft, and his frustration led into Ethereum. Not a false story, I believe it. Anyway, so I started investing in companies starting in 2011, and most of them I invested in when our business couldn't raise any money. And so the Jobs Act came out in April 2012. It's a revolution in crowd finance. It's changing how securities sold in the United States. Now, ordinary people can buy shares in a startup. It's crazy, amazing, and revolutionary. So I built StartEngine initially as a crowdfunding platform, and started, raising money for companies. And last summer, when the whole ICO craze started, I didn't know much about it. I read about it, and I started looking to further how things were working, and I realized that the ICO world was really a crowdfunding world, and we need to merge them. So bring the ICOs out of the shadows into a regulated world. And that's where it brings me here today. In the last, I guess, nearly a year, we've been working with companies to help them raise money with the Jobs Act regulation.
And that's pretty much Polymath's backstory, right, Graeme?
It's very similar, yeah. So mine, specifically about me, so I used to work in the world of finance. I was at an investment advisory firm. I just went, holy shit, this is so bad. And there are so many problems with capital markets and everything is so slow. And there are so many humans pushing paper around to do everything. So after I became completely obsessed with Bitcoin and cryptocurrencies and blockchain technology, I asked my friend Trevor, who's the CEO and co-founder of Polymath, who was building Polymath. I said, hey, what's Polymath about? And he said, well, we're the securities token platform. So what we're going to do is we're going to make every single financial security on Earth a token that runs on a blockchain, which is going to completely eliminate friction. It's going to reduce headaches of everybody involved in the capital markets world. It's going to make it easier to raise capital, and everybody is going to have a much easier and better time dealing with everything securities related. And I said, okay, I'm in, like, I'm starting to work tomorrow. So that's kind of how I became involved in the space. And yeah, Polymath, very similar to what Howard described. We're trying to make this vision a reality of securities tokens where there's actual regulated offerings that companies are giving. It's just the difference is now that these companies are giving their investors a token that represents ownership instead of a piece of paper that represents ownership.
Piece of paper that might get lost. And I think we can all say 2017 was the year of the ICO, specifically the scam ICO. There were hundreds, thousands of initial coin offerings, pretty much for utility tokens, where you could try to slide things through the regulations. And of course, we're doing it completely illegally, which is what made it so cheap and exciting. And then that's where security tokens come in. In my prediction, 2018 is the year of security tokens. And we kind of have a framework now. People understand, where are we headed? Where are we at now? And what's the future look like? Anyone take it?
I mean,
Yeah, go ahead. All right.
I mean, as you said, Matt, like 2017 was the year of ICOs, or like what people kind of tried to package as utility tokens, kind of bypass all the regulations and the rules around them. I think with recent rulings by the SEC and regulators around the world saying, okay, well, there is no concept of utility token, it's all securities. You're going to see that shift of going the non-regulated approach to the regulated approach. I mean, if you just look at the historical data for ICOs in 2017 and early 2018, 0.25% of that was actually security tokens, and even that wasn't fully regulated. You're going to see that shift of STOs or security token offerings starting to take over. If you look at the securities and assets kind of financial world, it's a trillion or even more kind of dollar industry, and if you're going to bring that to the blockchain, the only way you're going to do that is through STOs. We're talking about market cap and in the blockchain world. How can you bring it to a trillion or above? The only way you can do it is by shifting from what you know as ICOs and utility tokens towards the security token approach.
What are your thoughts on different crypto assets? So I've seen a lot of different terms thrown around. Currency is not the right one. ICO is not the right one. There are some utility, but there's not much utility happening today. How would you guys define crypto assets, both Polymath and StartEngine?
Yeah, I would say we still really don't know what to call a lot of these things. A lot of these things are, like, quote, utility tokens because they provide some utility, but the utility doesn't really exist with a lot of projects. And so what the utility is for the majority of the projects that have done an ICO is to be used as a currency. At this point in time, it's kind of the fuel and the thing that powers that network or gives you access to whatever service you're providing. So you could also think of a lot of utilities kind of as software licenses. So how do you use the Microsoft Word that you downloaded from Microsoft? Well, you get this unique identifier that's a software license, and now you have access to Microsoft Word. That's what a lot of these utility tokens are. So yeah, there's like these things that are utility tokens, which function kind of like a software license or a currency. There's a kind of actual currencies like Bitcoin and Ether. You could think of them in that way. And then there are these actual securities that are being created now. So actual regulated financial securities that are tokens on a blockchain. I'd say those, for me at least, are kind of the three main categories, but I know there's a lot of other ways that people have chosen to look at these things.
Howard?
Yeah, so from my perspective, I look at the world a little differently. So it turns out I'm a software engineer. So I see the utility token as critical because it's really the protocol that helps this blockchain application function. But people have created that into a currency, which is bizarre. And the reason is because they wanted access to capital. So for example, they will say, okay, we'll limit the number of coins to a certain amount, never to be grown ever, 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 which is very bizarre. That means that the successful protocol will die over time because they can't issue more tokens. Ethereum, at least, was smart. They agreed to create more as the market needs were there. And so because they were selling those tokens as limited number of supply, and then list them on exchanges, which are unregulated exchanges, that created a security. And they could have raised money from their cap table as an equity raise and then spend that money to build the blockchain application and the protocol and the coin used in the protocol. It doesn't have to be limited to a certain amount. And by doing that, they run afoul of security laws, the SEC, the CFTC, the Treasury, which is the most, FinCEN, the Financial Crimes Network. I mean, all of that happened because they just didn't understand how to raise capital, and they were smart to realize that the whole crypto community was willing to invest, and so for them, issuing a token made the most sense. Now that I think that's done, I think everybody agrees that because of the subpoenas and all of the SEC bulletins, you can't do that anymore. So what does it leave us with? It leaves us with this idea of a security token. But the problem is that the security token as a security itself, not equity, not debt, has no governance around it. And then when you want to use it on the blockchain, it's unwieldy. So that every time, it's like, imagine going to a Starbucks with a stock certificate in Starbucks and saying, I want a cappuccino. And they have to call the transfer agent, then they have to call the broker, and then they have to sell it. And then what do they give you back? Shares or money? I don't know. It is unwieldy. And I think you'll find in 2018, people were starting to realize, hold on a second, we can't do that. We can't have a security token operate a protocol. It's just not going to work. So I think the thinking we have to do is we have to change our paradigm and educate the marketplace to understand what it means to sell equity, which is cap table, which is debt, revenue share, royalties, versus a utility token. And there's really a big debate, I think, going on there.
I think the reason they were all raising capital via utility token sales was they were, for the most part, shit teams with shit projects that didn't know what they were doing, raising money from people who had no idea what they were doing and absolutely no business investing, or they put money in Bitcoin and made a fortune, and then we're like, what do I do with this? I need to put it into something. But how does that play out? Are we going to have multiple layers going between security tokens and utility tokens? Because you can't, the government, at least in the US, is making it a pain in the butt. If people actually want to be innovative with a utility token, it doesn't seem like it's possible in the US currently, given the regulatory framework.
Well, Matt, it is possible. So I've studied pretty much all of the SEC rules when it comes to the Jobs Act in detail. I may have read it 10 times in a row and all the bulletins. So here's how it works. It's very simple. First of all, the rules are very clear. When people say, oh, the SEC is not clear, the rules are not clear, that's why we sold utility tokens and we created a fraudulent offering, that's false. The lawyer that they use just helped them not follow the rules. The rules are very clear. Now, the Jobs Act is a gold mine. Use it. If you use the Jobs Act, not only you're following the law, it's amazing, it's cheap to use, it's less expensive than doing a utility token. But anyway, here's how it works. It's very simple. If you sell two tokens, one token is an equity, a debt, a non-convertible preferred, a revenue share, a royalty. Now you're issuing something that has value as a token. That's a security. It's a token. It has value. It has governance around it. For example, the shareholders have to meet to decide to issue more tokens. That's governance, okay? You need vote, you need resolutions, and all of these laws exist on the books in every state. Now, the second token, what is it? Is it a utility? Is it security? My pitch is this. if you make it a perk. What's a perk? It's like a bonus. If and when I have the token, I'll give it to you. Now, initially, it's probably a security because it's wrapped into the first token you purchased because it's one contract, right? But it turns out that once the blockchain is available, and you don't limit the number of coins on the blockchain, you say, okay, here's a math problem. How many tokens should I issue as the blockchain grows? Similarly, how Treasury issues dollars, same as Ethereum does, right? So I think that's where people are going to go. They're not just going to just limit the number artificially of tokens for a blockchain protocol, which is ridiculous. They're going to come up with a formula, allow it to grow with the growth of that protocol. Imagine if HTTPS, which is the protocol for the internet, said, oh no, we only have 1 million websites. It would not work. It would fail. So the two-token approach is the right one. Why? Because it goes back to basics, which is you issue tokens for your equity, debt, revenue share. Revenue share is non-dilutive, by the way. Unbelievable opportunities, and it's all in existence, all legal, no problem. Great security lawyers will handle it. And the second token, you have to figure out what it's going to be, but don't put it on exchanges and don't limit it in its size arbitrarily, because then it becomes really a speculative instrument. That's how I see it.
Yeah, but the thing is, like, and I agree with your point that that separation of what a utility versus security. But if you look at what's been happening in the industry, and I think what Matt was alluding to is that the fact that you're trying to prove you're not a utility token and the case of fraud are two different things, right? Not everyone that went and said we're a utility token was a fraud. Now, there was a lot of scam deals out there that happened that were actually utility tokens, because if they were a security, there was no way that it could have flied in the first place. But I mean, if you look just at the concept of a utility token, what is a utility? I mean, there's no future of profits. There's no distribution of profits, dividends. It's not a backed by an asset. I mean, that's what I define with a utility. I mean, which basically how we test, right, in the US, or alternatives for that in Canada or the UK, pretty much outlines what is a utility and what is a security. But I mean, if you're just going to look at the industry in general, how it's going to evolve, I mean, the SEC is saying everything is a security now because kind of you have that expected profit in the future because of the value of the tokens goes up. If I sell you a limited supply of gym memberships and then people start fighting for those gym memberships, the SEC is saying that's kind of going to be a security. I mean, there are a lot of utility projects out there. I mean, there's Civics, there's Bloom, which I just mentioned. These are kind of considered utility tokens that are not necessarily scam, but going through the utility approach, which allows you to bypass the security laws and the governance from regulators, is opening the door for scammy projects and fraud out there. And I think I'm not sure if that's what you were alluding to, Matt, in the first place, but I think that's how I see it. I agree with your point, but people are taking advantage of the bypassing of the Jobs Act or the utility token definition.
Well, basically, cryptocurrency.
Respond to what he said. I think there's a misconception about fraud here. There are people who actually steal money. They created a fake ICO, or they never had any intentions to do the programming, and they stole the money, right? That's one kind of fraud. But every time you sell securities to an investor without registering with the SEC, which no one will do because it's too expensive, like going public, or seeking an exemption, and there are plenty of exemptions, it is a fraudulent sale. Even though it's a real company with real people who have the right intentions, the fraud happens in the issuance and the sale. So when that happens and it's fraudulent, clearly, because they didn't follow the rules, the rules are very strict. Then you have on top of that the financial crime network, because if they didn't, on top of the seek the exemption, they probably didn't do the right anti-money laundering reviews, OFAC. Then there's a second fraud, which is you're breaking the Bank Secrecy Act. That's bad too. So again, I want people to understand here that when they talk about fraud, there are two really kinds of fraud. There's the obvious, I'm stealing money, but there's also, I didn't do it correctly, fraud. And both are very bad. And that's why I think we are in the situation where all these ICOs have issued utility tokens, but sold them as securities. They're in serious trouble, all of them. And not only, let's say the SEC doesn't go after them, that's fine. But the investors, if they lose their money and they complain, Then they can sue and collect. You know what? It's called a disgorgement or a rescission. They can ask the company to give all the money back. It is real.
I mean, that's why the terms I like to use is basically, I mean, I keep fraud and scam for something else. So scam is basically projects that are kind of, they're not intending to do the project or the programming, and they're just raising money and running away with it. And we've seen a lot in 2017 and early 2018. Fraud was, I guess, yeah, as you said, it's alluded to more on the financial transaction level. It's non-KYC, non-AML, the financial crime network, all of that will go into the fraud category. But if you're not, let's say you're running an ICO from Gibraltar and you're targeting US investors without having it run through the SEC or approved by the SEC, I categorize it as the non-regulated or non-compliant ICO or token offering. I wouldn't necessarily call it,
It is fraud. Here's the thing. What people don't understand is that you're a company in Gibraltar. Great. You're raising money from citizens of Gibraltar. Great, no problem. The minute you get one US citizen, one US person, let's call it person, resident in the US, US citizen, resident in the US, if you get one, now you've created a fraudulent offering. The SEC can claim and go after the company in Gibraltar. Now, you would say, hold on a second, Howard. SEC doesn't have jurisdiction over there. Hold on a second. Remember what happened in Switzerland. Let's remember, Switzerland was the capital of cryptocurrency when they have the banks, secret bank accounts. They've had it for hundreds of years. And the US undid it. How did they do it? They're a bully. They went to Switzerland and said, okay, listen, if you don't give me the list of all of the people who have bank accounts who are US persons and who in the Second World War were defrauded, if you don't do that, you don't do business with the US anymore. And guess what happened? Switzerland went to their government, then to the assembly, to the people, and said, we have to change our laws to comply with the US, and they did. And then there's no more bank secrecy.
One caveat, I've lived in Switzerland for...
Gibraltar is going to be bullied by the US if they onboard.
Oh, no, for sure. You can definitely use political pressure to kind of twist the rules. Of course, what you want to get, of course.
As someone who's lived in Switzerland, I need to add one thing. The US is now begging Switzerland to give bank accounts to Americans because they just flat out won't do it because America are shitheads to deal with when it comes to banking.
They won't take US citizens or persons. They won't.
Which is kind of a losing effort on the side of the US. But let's look at, so what I was bringing up was more, let's say we have autonomous vehicles and we're paying for these autonomous vehicles with micro payments, micro transactions. Am I buying a security to use a car, or am I using cryptocurrency? So there has to be some type of difference between here, and no one seems to know how to define it. It's very confusing. Go ahead.
Matt, if you look at it, just let's compare the traditional financial markets, right? I mean, something that you use to pay for a transaction or for a product or anything, I would categorize that as currency, right? And then anything that I'm holding to make a return on an investment, I would put that as security or as an asset, right? And if you're saying I want to use cryptocurrency, or let's call it X, to pay for an autonomous vehicle, I mean, I would consider that as a currency. You're not holding it just to kind of earn profits. Now, is that value growing, like the same value of Canadian dollar, US dollar growing over time? Is that now an asset? I mean, would you consider?
I can sell 1% of my house now because it's on a blockchain. So we have fungible value, which complicates things. I can sell a token. I can sell a stock. Let's say I have Apple and I need to go and I want to buy a laptop. Well, I sell my Apple stock and I get a MacBook.
It definitely complicates things, and especially just because this is a completely brand new technology that not everybody has wrapped their heads around. So, I mean, like, you might buy Ether because you're expecting it to go up in value. That's why some people might purchase Ether, but you might do the same thing with British pounds. So, I mean, like, those aren't securities, those are currencies. So it's very, very hard to think of, well, what bucket do these things fit in? And they might not really fit in any bucket. They might have to be their own separate buckets, but based on how regulators like to look at things, they have to fit into the existing regulatory system. And so I think we definitely have to start thinking of some of these things as currencies and some of these things as securities. So there was something that was recently put out by Coin Center, which is a lobbying group in DC, and they essentially said Ether is not a security. And it's not necessarily based on how the sale was done, but how people use the network and how the technology works. They said that should have a greater impact on what defines something as a currency or a security or a utility.
The problem is the US, every regulator is defining it as something else because they won't want to get their hands in because they're greedy. So it complicates things. Any thoughts on how the current the community can regulate itself? Is that the answer?
But Matt, you call them greedy. The regulators are not greedy. They're politically ambitious. They have political ambition. So let's be very clear what a regulator is. Most people don't understand what a regulator is. These are lawyers, super smart, bright lawyers who eventually will leave the agency to become attorneys at very big companies for law firms, or they'll seek political office, okay? So their ambition is translated in trying to, protect the investors, protect the investment public. And so I don't see them as greed. I think the problem is, Ethereum was issued as a security. Clearly, it was an ICO, but now it's no longer a security because it's used as a protocol, right? So the security became a utility, but they still violated the security laws when it was issued. But now it's a complete utility. There's no more true speculation, even though it's listed on exchanges. And those exchanges are going to get shut down anyway by the SEC. So let's not worry about the exchanges. But once the exchanges are no longer available, then where do you trade these things? If it's a security, you trade them on regulated exchanges. And if it's a utility, there's plenty of other exchanges that are available for utilities, more commodity-like.
What about decentralized autonomous exchanges or just token swaps, air swaps?
Like OTC kind of deals?
No such thing as decentralized. Bitcoin is truly decentralized. Most of the things you're seeing today are not really decentralized because they have a trusted source. So, the idea that, it's completely decentralized, I don't believe it. There's a few things that are.
But if you have a dragon that has 10,000 heads and the heads keep growing back, you have to kill it fast enough. So you don't have to be truly decentralized. You just have to be large enough not to fail.
No, you don't worry about that. You just get them at the gate.
No, I think what Matt was talking about, you have a couple of decentralized exchanges or protocols that are gonna coming to life. You have 0x and a couple others. That kind of is a notion of decentralized exchanges. Are they gonna be cracked down on those?
Yes, 0x, by the way, is decentralized, but it's not the exchange itself. If you look at how 0x was designed, you need the actors who are going to be using 0x, right, to be providing the securities or the utility tokens. It's not on 0x on its own. It's just
Howard, do you see any decentralized exchanges being successful in the future ever?
Well, again, what is decentralized? If someone's making money from it, that's done. They're over. They're going to get shut down. If it's something like 0x, which is a protocol that has its own life and there's no financial gain anywhere in it, then it's the actors who are working with it to gain money. They're going to have to be regulated. You see the distinction?
Yeah.
Like Bitcoin as a decentralized protocol works perfectly well. It's not a security. It was never issued as a security. So it's decentralized. It truly is. But most of the other things you're seeing have a trusted source somehow, somewhere. And at that point, the decentralization is no longer in its existence.
But then it's a race to decentralize before you get killed, right? Because you go from central to decentralized.
People want financial gain, right, Matt? They're looking for money. So if you create something like Bitcoin that's truly decentralized, there's no more gain unless you have kept a certain amount of coins and,
I don't think Vitalik cares about money anymore at this point.
Yeah. Well, it's not money. I understand it's not money, but by the way, Ethereum is different. Ethereum is truly decentralized. It's truly decentralized Ethereum. But when you talk about exchanges and when you have the idea that you're going to have different parties trading different things with some financial gain, and you want to convert those into dollars or whatever, at the gate is when the regulators can get you. So decentralized may not matter.
It's a fair point. I was listening to a podcast today, and it was more or less talking about once you have it in crypto, you might as well leave it in crypto because then, at the very least, there's not a choke point. So governments tried to get rid of the choke points, and then they found out, wait, now everyone's just holding on for dear life and never selling.
No, but Matt, there's one more thing, because there's two things in life that is certain. which is death and taxes. And you guys cannot discount the IRS. We never talk about them. They don't care whether you exchanged it into dollars or not.
As long as been a value or profit on your original investment, that's immediately a taxable event, right? Exactly. Whether you're selling your ETH and converting your profits to Bitcoin or Ripple or whatever you want to, that is a taxable event. I think that's what Revenue Canada or the IRS and kind of trying to cover. Have they figured out what's the best way to tax it yet? That's still a work in progress. I mean, if you talk to the IRS or Revenue Canada, at least Revenue Canada, they still haven't figured out how to tax you. But they know it's taxable, and you should be kind of declaring it as capital gains, right?
And you know what? The irony of the whole story is that, crypto is anonymous, except that the blockchain has all the transactions. It's like the weirdest thing ever. It's like the blockchain is the best thing that has ever invented for the IRS, because now they know exactly who to go after. Like when they went after Al Capone and got him on tax evasion charges so he could go to jail as a criminal, they got the bookkeeper, right? But you don't need to get the bookkeeper anymore. It's right there in front of everybody. And
yeah, but we still need to know who's key.
An arrow.
Well, don't worry. It's traceable.
It's also interesting to note that the people that are kind of trying to evade taxes or are doing something illegal with cryptocurrencies, the government so far has pretty much caught everybody they've wanted to catch. I mean, Ross Ulbricht from Silk Road, like if the government puts enough resources behind trying to catch someone, like they will catch that person. It seems to not really matter what the medium of exchange is. They can pretty much figure out where the bad people are, or the people who are doing something that they think is bad. They pretty much catch them if they are able to put enough resources behind the search.
Well, it's to Howard's comment, right? Because now they just have to go to the bottleneck, which is basically the centralized exchanges. I mean, the way the IRS went to to Coinbase and said, okay, I want the list of everyone who transacted over $20,000 that year, right? So at that point, Coinbase gets subpoenaed. They have to comply with the IRS, and guess what? Your anonymity is just gone. Like, unless you're doing peer-to-peer and like OTC or decentralized, there's no way of kind of figuring it out. Or maybe there will be at one point. You never know.
So does blockchain move over offshores? I mean, the U.S. seems to be the most hostile of all countries at this point.
I don't think the U.S. is bad. The U.S. is not hostile at all. In fact, the U.S. is the best place to do business in the world, period. It is. It still is. I know you're being skeptical. The Jobs Act, which most people don't understand, the Jobs Act is extraordinary. If you read it, you'll say, oh my God, it was built for Bitcoin and ICOs, okay? It allows you to solicit online. Most countries don't allow it. Most countries don't allow it. Now, if you're talking about other countries like Gibraltar, Malta, you're talking about Grand Cayman Islands, fine. Go live there. But you know what? Frankly, you're not going to find a lot of talent over there. The real talent, and I include North America, Canada as part of it, because Canada is extraordinary in terms of its ability to produce talent, like Vitalik, right? North America is still the best place to do business on earth.
It is. No, look, I think there's a lot of people can differentiate that where there's a lot of laws versus what's doable and what's not. I mean, the fact that there's regulations that you have to enforce doesn't mean it's a bad place to do business. I mean, yeah, I agree. The Jobs Act kind of paved the way, whether it's the equity crowdfunding, and that's one of the drivers for it, equity crowdfunding and peer-to-peer lending. When you had the Jobs Act, I find the UK environment even more friendlier than the US. I mean, considering there were more leaders within that space. Right. Is it getting tighter or not? Probably still more open than the US and North American market, Canada and the US for sure. But yeah, again, to your point, it's not. I don't see regulations necessarily a bad thing. If we want to move the financial world to if we're calling now FinTech 2.0, if you want to move it to FinTech 3.0, and you want to have that traditional, boring, outdated financial market to be on the blockchain, to adopt blockchain and move forward, you'll have to regulate that, because unless you bring that on, there's no way we're moving forward within that industry.
Definitely.
Yeah. I think a lot of the improvements that people like us can make to the financial markets, you can kind of get into the financial world with this kind of Trojan horse of being completely regulated. And then once you are completely regulated, you're doing everything by the book, you can see the certain areas that you can innovate. that are still completely okay with regulations, but maybe you figure out a way where you can use the blockchain to cut out a lawyer checking off a document tick box somewhere, or you can figure out how to try to automate some of the financial system in some way, but it completely has to be regulated in order to do that, because if a government like the US or anywhere around the world says all of this stuff is illegal and you can't do any of it because we hate it and we're just going to ban it completely, like that's not going to help anyone. So how we can really move the world forward, especially the world of financial markets, is by understanding that there are regulations, following the regulations, build things that allow people to easily follow the regulations, and then from there kind of innovate once we've digitized and put everything into the blockchain world.
So what are your thoughts on how initial token offerings and the whole blockchain ecosystem affects venture capital and raising money going forward, building businesses, DAOs? Anybody have any big thoughts?
Yeah, so I had Mark Suster at our summit last Friday. He's a very prominent venture capitalist, Upfront Ventures. They have about $2 billion under management. Anyway, he made a whole presentation, keynote, for 7 to 8 minutes. And it was really interesting to see him as a VC, his perspective of what he believes. And his biggest issue was why he doesn't like ICOs or STOs, I don't know how you want to call it, was that the idea of instant liquidity. That drove him nuts. He's like, I don't like the idea that you can do an ICO and the investor gets instant liquidity, but also the participants, whether the founders or their early the officers, and he went on a tirade about that. But then I had after his speech, I had a panel exactly on the subject, are ICOs disrupting VCs? And we had on it, the guys who founded Augur, we had people who were really from the ICO space and world and investing in ICOs, and they couldn't care less. They actually thought the idea of liquidity was a good thing. So you have a fight between those who believe that liquidity is bad and those who believe liquidity is great.
I mean, I agree. Look, I think the kind of tokenizing the venture capital space is a good way, one, for that liquidity approach. Now, whether I agree with you, okay, are the founders and the management team getting the tokens and the value of those tokens from the get-go? I mean, if a lot of companies, including Corl, for example, we're vesting our tokens, right? The management team doesn't get anything. We have lockup periods. We're not getting it from day one. But at the same time, your liquidity and the value of that token at the end of the day will depend on the success of the project, how big the project is. Whatever happens in the venture capital space, whether a company is performing good or bad, is happening offline. No one knows except those like the investors, the early investors on the board of directors. And if you're tokenizing that, your token value should be driven by how well the company is performing. Is it adding new partners? Is it adding new acquisitions? Is the client base growing? So that should be a driver for your value. And at the end of the day, as an investor, you can either keep holding your token and because you believe this company is going to go even further, or if the company is not performing at all, at least as an investor, now you have the option of getting out. I mean, how many startups out there have raised money and then failed to launch at one point, or lived for 3 years, 4 years, and then you never heard of them again? I mean, there's a couple of good projects that started like that and then collapsed over the years. And that kind of is giving you the option as an investor to kind of get out and liquidate. Are you losing all your money at one point? Maybe, but at least you have that option of getting out of an investment. I don't see it necessarily as a bad thing. I kind of agree it's more of upgrading the venture capital space. But I think I find it's more of a complementary add-on, not a replacement. I mean, venture capital is still good for some startups and giving up equity, not necessarily for everyone. But it's at least as a venture capital investor, you now have the option of, okay, well, now I have the option of buying equity in a company or buying a token, and then if that investment is not going well, I can get out, I can liquidate. And
how many Bitcoin billionaires are there? And how many people bought pizza for $1 bajillion because they didn't see the value going somewhere? That's the problem with liquidity, is people aren't smart enough to hold on to things that might be valuable in the future. So that you can crash economies.
I'm definitely in the liquidity is good camp. I mean, part of why Polymath is so exciting to me is that we can now have private companies and give those investors some level of liquidity. I mean, it depends on the number of investors that are allowed to participate just based on that offering type. But I mean, you can go from a situation where you have zero liquidity and your company essentially has a completely private multiple, like a completely private price to earnings multiple. And now you can give those investors some liquidity. And now the multiple on that company, you would think, would increase somewhat. It wouldn't be exactly a public company multiple, but it would be kind of between there. And so you kind of have this somewhat negative side effect of having immediate liquidity, where you can do things like where the private investors get into a round 1 week before the public, and then they immediately dump their tokens for an instant gain. Like that, to me, is kind of a negative side effect of immediate liquidity. But the added benefits of people being able to feel more comfortable funding early stage projects, to me, outweighs kind of the negative side effects. And as Sam said, I mean, you can still lock up. You can still make people vest. So there doesn't have to be immediate liquidity for every single person involved. You can still make the people who are actually working on the project and building it, you can still force them into vesting or into locking up for any period of time.
And there's a regulatory approach for things as well. I mean, if it's a security, there's a mandatory lockup period of 4 to 6 months where people come, like, I mean, at least in Canada, from a regulation point of view, because our token, for example, might represent an equity, there's a lockup period of 4 to 5 months that you have to enforce to kind of avoid the arbitrage or the pump and dumps that you were just talking about, right, Graeme? I mean, is it everywhere? Is it going to be enforced everywhere? I don't know. I'm not a securities lawyer at the end of the day, but that can be enforced. So if there is a concern that, oh, some investors are going to go in on the pre-sale or a few weeks before and then dump it to kind of have that intense liquidity straight after, there are protection measures against it. And I'm pretty sure if the regulators are going to start allowing more STOs in the industry, that's something that they're definitely going to be looking at.
But Corl has dividends.
Because you guys covered a lot of things that your audience may not understand. So the idea if you're a venture capitalist and you have a fund, and the fund holds securities, right? Companies, shares in companies. You're limited to 99 investors, unless you register the company under the Securities Act of 1940, which is like really going public. Those are the mutual funds, open-ended funds, closed-ended funds. They exist. You know, you'll see them all over the place, but they're super expensive to operate. Could be $1 million to $2 million a year. Not going to happen, right, with the VC. So in a way, the VCs their model is antiquated. So now going back to where we're seeing the opportunity, it's like going public. When you go public, your shares are publicly available, except that the insiders are subject to Rule 144, which makes them an affiliate, which means they cannot sell more than 1% of the trade. They are limited to no more than a certain amount per month. And they have to do it after they disclose the financials. They can't have any insider information. I mean, you're talking about amazing regulation to protect the investor from the insider cashing out illegally. So in a way, think about this. The whole idea of tokenization of all these amazing assets is like going public, except that today, if you want to go public, you have to be an enormous company. There's only a few hundred companies who go public a year. And you're talking about raising hundreds of millions of dollars. It's just ridiculous. That's not even a fraction of a percent of the companies in North America. However, what we're doing here is offering to the general public the ability to invest in companies who are going public. These are public offerings, by the way, in the tens of thousands. This would be amazing, right? We are going to democratize capital in a way that no one has seen it before, because the stronghold of the capital markets today, which are the Goldman Sachs of the world and the NASDAQ and the New York Stock Exchange, is only available to the elite of the elite. And everybody else, you have to go into the pink sheets, you have to go into the OTC, over-the-counter market, and these things are just not, the liquidity level is not there. But if you look at the blockchain today with those so-called exchanges, there's true liquidity. If you can move that excitement over to regulated exchanges, you've created something that is much more powerful, much more bigger than the capital markets that we have today.
And I think that's one of the add-ons or like value added that Polymath is bringing to the table. I mean, with the concept of STOs, or that you can embed all those regulatory rules within your smart contract and your token, right? Whether it's lockup or whether what can be sold and what can be bought and who can buy it and who can sell it. And that's what to adapt that financial world and bring it to the blockchain. You have to regulate it, and to create the infrastructure or the protocol to kind of support it. And I think that's one thing that we like working with Polymath on, is that we are embedding our financial regulations, whatever talks we're having with the regulators, whether it's pre-sale rule or issuance rules and lockup and who can get what, and all of that is embedded in our token with the Poly protocol.
Yeah. So that's what we're really excited about. I mean, so for that example where somebody can only sell up to 1% of their holdings, I mean, like the way that's restricted today is by somebody saying, hey, you can't do that. I mean, like that's literally the restriction, is that a lawyer won't sign the documents or something like that. But what if you could actually program that into the token itself, where literally it cannot move more than 1% of the token holdings from any one
transaction
person who holds it?
Yeah.
So, I mean, like that's the really exciting stuff that's happening in the capital markets world that we're trying to usher in, is how can we take all these things that are generally done by securities lawyers and other humans that say, hey, you can't do that because of regulations. What if instead you can program those things to not occur, or program things that have to occur? Like that's really exciting to us.
But then that means you're going to have to make a deal with all of the regulated ATS trading systems, because if you're going to use Rule 144, you have to look at the average trade volume. So that means you need a trusted source.
Yeah, there's still many things that need to be done in order for this world to become a reality. It's going to be a very long road.
Well, including, for example, like withholding taxes, right? Yeah. If you're paying any dividends or return on investments, I mean, how do you embed that in your smart contract and your token offering in the first place? And then every country has its own different withholding tax rate. Now, am I going to go over every country, or are you going to just have a general number? You know, that's still, I mean, with hopes like one day you'll have an international body that kind of agrees on like a flat white paper that's like, these are the major rules we're going to follow. But I think we're still debating internally within each country and each jurisdiction. I think we're still
right, Sam. You're right, but I don't know if you know, but in Europe we have the euro in, I don't know, like 27 countries, except that the security laws are different in all the countries.
Exactly.
It's insane. It's
unified currency. Unified.
You have a single currency. I mean, I grew up in Europe, so I'm pretty familiar with the system there. It is unbelievable. So that's why I still say that North America is the greatest place on earth. Why? Because you have an enormous marketplace that's unified. But when I say unified, one thing is careful. There's a thing in the United States called blue sky laws, which basically defines laws in every single state. I'm not making it up. But good news is the Jobs Act have preempted the blue sky laws. And that's why I tell you, the Jobs Act is so amazing. It's a gift that keeps giving. The things they put in there are so amazing that it's actually giving the US a huge leg up. So when Matt, you say, oh, everybody's going to move to Gibraltar, I disagree. I think everybody is moving to the US.
I would say they'd go to France.
Oh, yeah, let's go to France.
Where you can invest and not have taxes on crypto.
Well, no, you still have taxes, but they're actually smart. They're doing the 1031 exchange rule in France. So basically, they're giving you a way to pay less taxes. So everybody who's listening to you absolutely move to France, except that France doesn't necessarily let you go there.
They're not friendly either.
Not exactly. I'm just letting you know.
So I wanted to float something by all of you guys that I think would be interesting. Right now, Eric Ries is working on the long-term stock exchange, because the problem that he sees and the problem that I see with the current public markets is because it's moving so fast, the focus isn't so much on the future as it is on the present. We talked about this a little bit before, Howard, but what would your thoughts be around tokens or stocks, securities, et cetera, that could only be sold on a set basis, so 4 times a year, 8 times a year, et cetera, so that companies actually had a chance to build something before the markets were moving up and down based off of nothing?
Well, that's the elite system of the hedge funds, right? I think the reason Eric is going to have a hard time getting his exchange approved and licensed by the SEC. By the way, he's licensing an exchange, and it's going to take him 5 to 10 years to get there, if he gets there. So when people say, oh, I'm going to take my so-called exchange, cryptocurrency, and register with the SEC, good luck. We'll talk in 10 years. But anyway, so his is going to be a problem, because if you think about it, the ordinary investor, the Main Street investor, can't suffer the idea of holding something for a year or quarterly. They may have liquidity needs right away. And that is, to me, in itself a problem. The issue that he's trying to solve is to create more longer term companies. A little bit like the VCs are saying, when they make an investment, is 5 to 7 years to let the company grow and become more mature. But I think that's, it's basically against the true nature of a public offering. The idea that, oh, I'll invest in the stock and hold it for a year or longer, that's could be your choice, but you need liquidity. And I think the reason capital markets work is because of liquidity. So I think he's going to have a hard time.
What about a quarter, not a year? Something shorter, but something that, I mean, the public market trading, stock traders, it's just arbitrage. They don't create value other than the value they create for themselves.
No, they create something fundamental. They create liquidity. You can't discount the idea of short-term holding as something bad. The liquidity is the real value. The revolution we're all talking about here today is to create liquidity with assets that don't have it. And we need to respect that. So what Eric Ries is proposing is really not in line with at least my views, which is to create that liquidity.
Yeah, I think that exchange is an interesting idea. But I mean, if I'm an investor and I have option A, where I can use an exchange where I can trade every day, or option B, where I can only trade 4 times a year, I'm never going to go to that one.
It depends. It depends unless you have a hybrid, right? Like if you take, I mean, if you're earning dividends, for example, or short-term returns, if you have like if your token, your investment is split between a long-term return and a short-term return, where you, for example, you're allowed to do 4 trades a year, but within the first 3 months, and then the next 3 months, you're still earning dividends and you're getting those short-term returns, it could be lucrative and interesting for people, because now that's kind of pushing it to hold for a while, but you're not holding for free. You're not missing an opportunity. You are still getting some return, short-term return on investment. And if you kind of have that hybrid, it will work. That's what we do. At least we're not you're not just trading 4 times a year, but you are getting those dividends or returns on a quarterly basis at least. So you have that short-term return. And if you just want to hold the Corl token at some point, you can hold it.
If you don't buy junk food and have it in your house, it's not hard to not eat it. You buy it challenge every day.
Fair enough. I think it's also interesting to note that these are things that you can program into the token. So like with Corl, you can program it into the token. So an exchange doesn't really need to exist to enforce that rule. I mean, like tokens can enforce that rule themselves, and companies can actually utilize these types of rules and restrictions to make their offerings seem more presentable to certain kinds of investors. So it doesn't necessarily have to be enforced from a top-down way from a regulator or from an exchange anymore. You can program these things into the securities themselves.
Yeah, but you're going to have a very tough time, because the rules of securities in this country, and I'm talking about the United States, is without using a broker-dealer to do the trade, you would have to figure out a way how to make sure it's a true peer-to-peer system, and there's some legal ramifications around it. In which state the person lives, so what state are they a part of, and what are the specific laws in each state for the transaction to be legal. You need to create a purchase agreement that is signed by both parties. It's very complicated. And if the company has a transfer agent, they have to also do the clearing of that trade. So I'm thinking, when you say, oh, we can build it all into the token, here's what's going to happen. That's maybe true in one day down the road in a long, long time. But right now, you're going to have to accept that the regulated exchanges, those are broker-dealers with alternative trading systems, are really going to be the ones supervising the trade and make sure that it complies with blue sky laws, complies with SEC rules. And I wish I could tell you, oh yeah, we can get rid of that. I don't think so.
No, and I agree. To Howard's point, like as soon as you're now the facilitator of that transaction between point A and point B, you're now the broker, you're the transfer agent. Like you have all of that. Now you have like so many licenses and so many loopholes that you have to go through just to get the regulatory approval. Even if you've embedded that in the smart contract, at the end of the day, if you are going the regulated approach, one of the first few questions that security regulators are going to ask you, well, how are people trading the tokens? Is it happening through you? Are you facilitating that? I was like, well, now do you have the broker license for that? Do you have this? Do you have that? I think that complicates it more. But like that, I think that's more the vision and the dream, or the like that we would like to reach at one point. Are we there yet? I don't think so.
Yeah. So I mean, I'm talking about stuff that we can do.
Yeah.
I mean, like I'm not talking about stuff we can do today. Sadly, it's really not possible. But it is something that is now technologically possible, given enough infrastructure being built out and enough regulations kind of coming to terms with this possible future. But yes, I mean, that's why Polymath's partnership with T0 is important, because T0 is an ATS that's licensed by the SEC, that it has the ability to trade securities tokens. So, I mean, there still will be ATSs, there still will be centralized exchanges for the foreseeable future. But these very cool things that we can do are things that can technologically exist.
And that's a big part of the reason that Corl partnered with Polymath. Can you tell us a little bit more about Corl now, Sam?
Sure. So what Corl would you do as in essence as a product, we do revenue sharing or revenue-based financing investments in emerging companies. So if you look at the fundraising spectrum, you have the option. The traditional way was either debt or equity, and there was the royalty concept, which was known in pharmaceutical and oil and gas. So we kind of took that concept and said, okay, well, how can we bring that to the startup scene or the emerging tech and company scene, where we find an approach that's non-dilutive for startups and entrepreneurs, more friendly, aligns your interests as an investor and as a company. And that's where the Corl vision and the Corl product came to life. So as a company, we deploy capital in those startups and growing startups over the years. And then in return, instead of giving us a board seat or an equity, they pay us back through a percentage of their revenue on a monthly basis until that investment is paid back with a premium that we call a repayment cap. Now, the way the Corl token ties into that, Corl is going to be one of the world's first security token offerings, and that's happening through the partnership with Polymath as a protocol. So the Corl token represents an equity in our company. As a token holder, you will earn a type of Class B share. It allows you to earn dividends on a quarterly basis based on our profits. And in a way, you're indirectly investing in those startups through Corl. So instead of having a peer-to-peer transaction or peer-to-peer revenue sharing deal, you invest in Corl or purchase the token, the Corl token, and then the funds that we raise during our token sale will ultimately be deployed to help those technology companies grow, and without having any restrictions that could be set by venture capital. I mean, if you look at the venture capital space, and we've talked about that before the call, Matt, like VCs turn 90% of the deals they get, if not even more. And so that's kind of one of the things we focus on. They're not being turned down because they're bad deals necessarily. It's just that they're not the home run company, right? That's going to earn you 20x return, but they're still getting cash flow positive. They're still going. They still have that transaction volume that's happening on a monthly basis. And these are the type of companies that we focus on helping grow.
Exactly, and that's why I'm excited about Corl as well. Now, from each of you, it's been about an hour. I want to wrap this up or start to wrap things up. I want a bold prediction from each one of you, something that's tangible that has a date involved. I'll let you go first, Graeme.
Okay, let's go. By, let's say, December 31st, 2019, there will be $1 trillion of securities tokens.
Howard?
2018 is going to be regulated trading marketplaces and the death of exchanges.
2018, I guess, first security token offerings and regulated security token offerings trading on North American security token exchanges.
And my bold prediction will be that the US doesn't win this battle. It's probably Singapore. I don't know how to put a date on that.
Singapore?
What?
Have you been to Singapore?
I have been. It's an incredibly regulated country, but incredibly innovative and forward-thinking. It's kind of, it reminds me a lot of China, but it's so small that they can move faster.
Well, if you can give me some great innovation that came out of Singapore, I'd be very interested in hearing about it.
I mean, when you've only been around for 50 years, it's slightly tough. But I don't have a good one.
Israel, by the way, Israel has been around the same amount of time, and I can give you a huge list of innovations that came out of Israel, including the drip watering system, the Ambio burst system, and so many drugs, and by the way, and also technologies like Waze. So what's the difference? Explain to me, how do you explain
Israel has no political
have the
stability.
same lengths of time, but look at the difference of the technology innovation coming out of them? How do you explain that?
It's hard to invest in a country that's surrounded by enemies versus one that has pure neutrality.
So why are they more successful in Israel than Singapore?
Because they have to be. They have to fight back. But that doesn't mean that's not ultimately long term. But that's a little political.
Yeah. Well, Matt, to your point about Singapore, I was like, yeah, it's been a haven for utility tokens, but as soon as you start getting to the security tokens offering, I'm not sure where Singapore stands yet. I mean, a lot of countries, a lot of token offerings have avoided Singapore among other countries, right? And their token offering just because they don't want to be classified as a security offering. There's no rules that you can follow. For example, in the US and in Canada, they say, okay, well, you want to be a security token offering, this is the regulator you have to talk to, and these are the rules that apply. Whether it's the Job Act and the Howey test in the US that you have to go through, the Canadian regulators in all provinces. I don't think in Singapore there's been a framework. Now, are they going to come up with a framework tomorrow and then become popular more than the US? I don't know. We'll have to see. But I'll have to take Howard's side.
I didn't mean security. I meant cryptocurrency.
Oh, just cryptocurrencies in general.
Yeah, the future of the crypto asset space. We'll have to see though.
Or you could go to Switzerland to
it's too expensive. People think that everyone's there. I actually lived there. No one's working out of Switzerland because it costs a freaking fortune. Their currency should be 40% cheaper than it is. But that is what it is. I want to give everybody a chance now to plug themselves. So we'll go from left to right. Graeme, tell us a little bit more about Polymath.
Yeah, so Polymath is the securities token platform. Polymath makes it easy for companies to raise capital and issue financial securities. And now these financial securities, how they're different from the traditional world is that they are tokens on a blockchain instead of a piece of paper, or a piece of paper that's been digitized. What we've built so far in terms of our technology is a protocol that we call ST20. And so it's a protocol that allows for the restriction of trading of ERC20 tokens. So the securities tokens that we're helping companies create and then issue are ERC20 tokens with additional functionality built in that can restrict secondary market trading, which makes them now regulatory compliant. So a lot of people, and for example, when they're conducting an ICO, if a company is conducting an ICO, they'll KYC and AML verify all of their initial investors or their initial purchasers of the token. But then what's to stop somebody from buying into that ICO and then immediately turning around and selling that token to somebody who's an ISIS? Okay, so now the company has essentially funded terrorism, or they're at least somewhat involved in terrorism. So that's a problem. And so to make securities tokens a reality, Polymath has said, okay, cool, this technology of ICOs and using tokens is really, really great for capital raising. But in order to make it regulatory compliant from the mindset of who's actually holding these tokens, you have to be able to restrict secondary market trading. And so that's what Polymath has built the protocol for.
And that's why we partnered. Howard, can you tell us a little more about StartEngine?
Sure. I mean, StartEngine, as I explained, we help ICOs raise capital. They could be also called STOs. But we also are building our alternative trading system so that we can help do the liquidity for those securities that are being issued. We're also a registered transfer agent with the SEC so that we can hold the records for all the companies we issue shares for, or securities. This year, we're going to do about 300 to 400 issuances. So we're probably going to be the most active funding portal in the United States. And our vision is really to work with everyone in the industry, including the people we all know, to build the right ecosystem that is fully regulated, fully in compliance with all the laws, hopefully in the United States and maybe other countries as well.
And then Sam, take it away.
Right, so I guess we already covered Corl, what we're doing. So I mean, I mentioned what we're doing at Corl and what the token is representing, but I think I'll take the chance to share the vision of why Corl and what we're doing. We believe that the fundraising scope and space hasn't been evolving the way it should. I mean, we take the traditional sense of venture capital, and then we kind of added equity crowdfunding to it, but that's still kind of limiting companies with the way they raise money. It's not aligning the investors and businesses' interest at the same time. And I think a new way called royalty or revenue sharing being adopted by those companies and being used as a fundraising method is something new. Now, the concept of royalties itself is not new, but the way we're adapting it to the tech industry and emerging companies, that's something that we believe in, allowing those businesses to grow without any restrictions, especially if you just look at North America in general. You have companies taking 5 to 6 years longer now to exit. And as an investor who is investing in a company, now you're expecting that home run and return of 20x, 15x, and which you're not going to get anytime soon. So I think that part of that vision of launching the Corl token and tying it to either royalty or revenue sharing investment kind of sustains that growth for both businesses and investors. And that's just what Corl 1.0 today is. We'll be releasing more info about what Corl 2.0 and 3.0 as a vision to come after that soon.
And this is all sponsored by Corl, where I employed. Chief Growth Officer, Sam's our CEO. Just wanted to let you guys know that this is not financial advice. We are not planners of any kind. We are not in any way, shape, or form giving you any type of solicitation. And then this is not advice. Go do all your due diligence. Corl.io, StartEngine, and Polymath. I want to thank you guys for coming on and thank everybody for tuning in. And until next time, yeah, it's game time. Hit subscribe button. We'll have some more great roundtables coming. And yeah, we'll talk to you again soon. Cheers.
Thanks, Matt.